This week, we're looking at accounting, which your text defines as identifying, measuring, and communicating financial information to provide interested parties information necessary to make good decisions. That definition is fine as far as it goes, but to really understand what accounting is, you have to understand the difference between data and information. Data are simply a collection of facts and by themselves have no real meaning. Only by placing data into context are we able to derive meaning from them, and when we do so, we create information. The field of bookkeeping is about collecting financial data, but accounting is about making those facts recorded by bookkeepers into useful information. For example, if we know that a pumpkin bucket costs $1 at Target, what does that tell us? If we're Target's CFO, does that single datum give us any meaningful information? Not really. We need to look at it in context. For example, if we know that the cost of goods sold, CGS, for the bucket is 32 cents, we know that the gross margin on the product is 68 cents, and that the gross profit margin on the product is 68%. If we know the number of units sold, we can figure out the revenue we derive from the product as well as the total contribution margin. The field of accounting is generally divided into 4 areas: managerial, financial, auditing, and tax accounting. Each area of accounting provides information for a different audience and for different purposes. Managerial accounting provides information to company executives in order to allow them to make good management decisions. Because this information is for insiders, it is generally confidential and not made widely available. Managerial accounting is concerned with issues such as cost accounting, planning, controlling, and tax accounting. Financial accounting provides information to people outside the company, such as prospective owners, creditors, customers, suppliers, government agencies, and the public. The accounting scandals that brought down HealthSouth, WorldCom, Enron, and others, and which led to the passing of Sarbanes-Oxley, all involved financial accounting. Financial accountants prepare annual reports according to generally accepted accounting practices as defined by the Financial Accounting Standards Board. Auditing is the process of reviewing and evaluating records to ensure their accuracy and reliability. Internal audits evaluate the accuracy of accounting methods for company executives, and independent audits evaluate the accuracy of a company's financial reports for the public. Tax accounting is a specialized field involving accountants trained in tax law who prepare tax returns and tax strategies to minimize a company's tax liability. In order to provide a picture of a company's financial condition, accountants prepare several financial statements, each of which focuses on different aspects of a firm's operations. The balance sheet shows profits and losses as of a specific date, usually the last day of the fiscal year, and is based on the fundamental accounting equation, assets equal liabilities plus owner's equity. Tangible assets are divided into long-term assets, also known as fixed assets or property, plant, and equipment, PPE, which include land, buildings and improvements, equipment, vehicles, and furniture and fixtures. Current assets are those assets that can be converted to cash within 1 year and include raw materials, work in progress, finished inventory, and accounts receivable. A company's intangible assets include its goodwill and its intellectual property, trademarks, copyrights, patents, and trade secrets. Liabilities are similarly divided into current liabilities, which are due in less than 1 year, and long-term liabilities, which are due in 1 year or more. The income statement shows cash flows over a certain period of time, usually the company's fiscal year. Cash flow is the most important aspect of business, particularly for small businesses and startups. Without cash flow to sustain operations, profits are irrelevant because the business cannot remain in operation long enough to make a profit. Accounting also uses financial ratios to evaluate various aspects of a company's financial condition. Liquidity refers to the amount of cash that a company has access to, and liquidity ratios such as the current ratio and the acid test or quick ratio provide an analysis of a company's cash flow and the likelihood that it will be able to pay its bills as they come due. Debt or leverage ratios, such as the debt ratio and the debt-to-equity ratio, measure a company's ability to repay its long-term debt. These ratios also give an idea of financial risk in the event of an economic downturn. The more leveraged a company is, the more it suffers when business declines. Finally, profitability ratios such as earnings per share, return on sales, and return on equity evaluate financial performance and give an idea of how well a company uses its resources to generate profits and also to generate shareholder value.